2 years ago, Maria Cordoba, the woman here, trembled for her life in fear underneath a pile of rubble that was her house that collapsed in a landslide. That landslide took the lives of 254 people in Mocoa. It injured over 300 people. And this mudslide left the lives of about 45,000 people affected. Only 69 people in this community had any insurance. So the devastation that they had continues to this day. Many would have been able to be the beneficiaries of an insurance policy that would help them to bring some dignity back into their lives. But instead, the struggle continues. The thing in my experience that we have to understand is that most people don't recognize the social good that is insurance. Insurance is seen as a product that causes fear, uncertainty, doubt amongst our potential consumers. It's not seen as something that's there to help people at these most devastating times. And I want to hold us to account for the way that we've positioned our products and services to the consumers and use this incredible new tool called behavioral economics that'll help us understand the psychology of the consumer, help us understand why they don't understand buying insurance and the role that it could play in restoring the lives of their communities in the event that tragedy happens. We can't prevent landslides, but we sure can do a great job of helping address that disaster. So I want to give you the tools to be able to understand how behavioral economics can help us do a better job of bringing insurance to the people who need it most. So our approach, first of all, our approach itself is typically very misguided. You see, one of the things is that marketers generally, the ones who have that frontline accountability with customers, marketers often love to try and educate customers, to try and get them to understand insurance, and they go through that process. We need to take a more realistic view. So the traditional view of insurance has these fundamental theoretical assumptions built into it. Now, we have to bear in mind that many of us in this room come from backgrounds and fields like finance. You know, how many here studied finance or economics? Who has a background in this kind of quantitative skill development? We probably have people who have engineering backgrounds and other kinds of technical skills. And even those of us who come from marketing or more human-based fields, generally, the fundamental assumption that we're operating with, maybe whether we realize it or not, is that if we give people education, they will understand insurance, and that people care. We assume that people care about what's in their insurance, and that people will find out what the best policy is, and they'll buy the right coverage. That's the traditional view. But what this does is it fundamentally doesn't take into consideration some of these biases that now we're really starting to learn through behavioral finance and behavioral economics. These are the barriers that we have to overcome in order to help position our products with our clients. So one of them is that people tend to be overly optimistic about their future, whether it's choices that they can individually control or factors about their environment. People overlook what potential disasters could fall upon them. The other one that's very interesting that makes your job incredibly difficult is that you sell an intangible product for an intangible risk. And yet we all like to think very concretely. In fact, we like to think about, for instance, the one thing that's very concrete is the money we have in our wallet, which we want to take and have them invest in something that's intangible. So this factor of people like to think and have concrete things is very difficult and important for us to recognize. So if we think about some of these biases, then we could start to maybe have more creative approaches in terms of how we are supporting our clients. Another one, a very obvious one, is this notion that we're present biased. And even if we do get people to think about buying insurance, they tend to want to leave the action to later. They'll procrastinate and get around to that later. And then last but not least, people are price focused. I want to spend a little bit more time talking about price focus in our industry, because I think that there's some very important insights for us there to learn about the decision-making process. So behavioral economics then is a very important tool for you, because it will help us all to understand why do people do what they do. So I'm going to dig a little bit deeper into some of the biases that will be helpful for you to understand customer behavior. So one of them is the Dunning-Kruger effect. People don't know what they don't know. That makes it very hard for us to sell to them. In the event that they do have some perception about the insurance industry, generally it's a feeling of distrust, a sense of unfairness, or that we're actually trying to take advantage of people. They think that there's a low perceived value to the product, that there isn't a benefit that is commensurate with the cost that they'll be expending on the insurance, because they don't necessarily think that they'll ever be in a position where they're making a claim. All they see is the cost side. Again, on the action, when people are actually purchasing insurance, we tend to see them operate on a very price-focused basis. That's not necessarily a good thing when it comes to ensuring that our clients are buying the right products with the right amount of coverage. And then last but not least is this say-do gap. People don't remember why they might have purchased the insurance in the first place. This is one of the biggest challenges that we have in terms of retention, or at least retention of certain amounts of coverage that they would have received. So we might not have a full defection. What we might see is a diminution of the actual amount of coverage that they purchased. And so we need to understand what some of these barriers do. So the challenge is we risk using strategies that don't take into account these biases, and therefore we're leading people to take approaches or take strategies that leave them in a position of not having the right amount of coverage. So let's talk a little bit more about price focusedness. So here's how I'd like you to think about it. You know, very simply, imagine we're out shopping for an item like a vacuum cleaner, or some other appliance. And when we're comparing amongst these different, simple appliances, it becomes very easy to compare some of the differences. Maybe there's sort of the strength of the machine, maybe some of the components, maybe the style, maybe the brand. So it becomes easy to compare those features. And then another aspect that's very easy to compare is price. So all things being equal, to compare very complex attributes versus price, we're not selling vacuum cleaners. Those features and attributes of a vacuum cleaner are easy to find the one that's a cheap, lower cost budget item, and what you sacrifice for that versus, let's say, the Dyson appliance, which is very powerful. Because we're not selling vacuum cleaners, and because it's very difficult for our customers to make a comparison, they compare on the attribute that is the easiest to compare. The number 50 is lower than the number 60. I'm not seeing what else I'm possibly losing in that sacrifice. So what happens is we tend to compete with each other on the basis of price. It's an easy way for us to talk to a customer because it's easy for them to see this number is more expensive than that number. But the rest of that trade-off is incredibly complex. And so the way we are thinking about customer buying processes clouds our customers' ability to think about more than price. So we have the wrong assumptions then. We believe that customers will be able to make a comparison between prices. We believe that our customer will be able to understand the trade-offs that they're making. Or certainly we're acting in that way. But bounded rationality is one of the most fundamental concepts of behavioral economics. So if you learn this concept, you actually have the fundamental principle from behavioral economics that I'd very much like for you to think about how this affects your customer. This term, bounded rationality, what it means is that, behavioral economics isn't saying that everyone is stupid. That's not, sometimes it seems like it, but we're not saying that. What we're saying is that we're boundedly rational, which just means that we have limits. We have limits. We have limits in the amount of time we have, or energy we have, or ability to dig in for information or learn about something before we make a choice. So our ability to be fully rational is constrained. And then on top of that, we have people who are poor, or don't have good educations, and so additional constraints that they have is their ability to devote cognitive energy. They're in a situation of often facing stress in their lives, and they have even less mental energy to devote to, for instance, learning about insurance. And so if we understand then and are sensitive to this limited and bounded rationality that people have, we can start to now understand, how do people make decisions? How do people make decisions? So we've developed these concepts in the field of behavioral economics. One of them is called heuristics. That's based on a Greek word. And what this word heuristics means is, if we think about the different ways we make decisions, one of them is, fully rational, totally calculating. Maybe we use a spreadsheet. We think about all the variables that really matter. I bought a sailboat, and I had a spreadsheet that had every single different dimension. It was exhausting how much energy I put into this sailboat. Now, if only we use this kind of analytical process for other decisions that maybe matter more, but we can't, or we make choices otherwise. So then, what do we do to help us make decisions? We use these things, heuristics, and these heuristics are mental shortcuts. Now, a mental shortcut could be a very, very reasonable way to help us make a decision. So one of them might be, what's most popular? What is everyone else doing? And to follow the herd. And sometimes that is a very reasonable way to make a decision. Other times might be to follow the advice of an authority. What do the authorities recommend? And we trust that they've made the decision, and so we'll yield to following that advice. So those are heuristics. So we use these other things to stand in for us doing the heavy lifting on the decision. Are we thinking about that process when we're thinking about how our customers are making decisions? Are we thinking about how they might be engaging in mental shortcuts? And are we supporting that process to help them make a better decision? Because sometimes heuristics can lead to biases, can lead to people making suboptimal decisions. For instance, following the herd might lead people to follow the wrong advice. Trusting an authority, for instance, might be actually trusting the wrong person who's also giving us bad advice. So there's a relationship between us using a mental shortcut and then sometimes those shortcuts being fraught with bias. And I want to show you this process in a little bit more detail. So one of the things is our biases as humans are large enough and systematic enough that we can actually say that we are predictably irrational. So I wanted us to do this together. So my question is, how well do you understand human behavior? And so let's imagine a scenario. I want you to imagine a scenario where you've decided to see a movie, and you go to the theater. You've put 20,000 pesos in your pocket before you left the house. And now I want you to imagine you're at the movie theater, and you're at the box office, and you reach into your pocket for that 20,000 pesos, and you find out it's missing. You probably dropped it along the way, and you won't be able to find it again. So now my question to you is, would you be willing to pay another 20,000 pesos for a ticket? So If you're at the theater, would you be willing to do that? Could I see a show of hands? Okay. Now, I'd like us to, so most people in this scenario say they would. They'll say they'll take out a credit card or more money, and they will still pay. So now I want to introduce you to a different scenario. Now imagine that instead of having cash in your pocket, I want you to imagine a scenario where this time you had purchased the ticket earlier. The ticket is in your pocket. You had some time before the movie started. Maybe you did some other shopping. Now I want you to imagine yourself back at the box office. I want you to imagine yourself reaching into your pocket, and this time it's the ticket that's missing. Now, same question. Would you spend another 20,000 pesos to buy another ticket? Raise your hand if the answer is yes. So we have less than what we had before, and there's a delta. So the first time when we had the cash in our pocket, most people say yes, and they think, oh no, I've lost some cash, and they're sad about losing some cash, but they're willing to still go to the theater. In the second scenario, we have the ticket in our pocket, and some of us might be resistant to seeing the movie because we might tell ourselves, I'm not going to spend 40,000 pesos to see this movie. The reality is, in both situations, when you go to sleep that night, you're still out, you still spent 40,000 pesos. It doesn't matter that it became a ticket in the second scenario. It doesn't matter that you bought a ticket and you're spending it again. That process is called mental accounting. And this is where it's an example of us actually not being fully rational. If we had the $40,000 to spend the first time, we still have the 40,000 pesos to spend the second time. I want to give you another example to reinforce this concept. Let's imagine that we're shopping for furniture, and we're interested in buying a lamp. And we see the lamp in one place for 100,000 pesos, and it's a nice lamp. But then we find out that exact same lamp is at a different store about 10 miles away, and it is 50% off, and so it costs 50,000 pesos. Would you be willing to go to the other store? Most people say yes. Okay. Now, I'd like us to imagine a second scenario. Now, this time, we're looking for a new table. And this new table cost 5 million pesos, and we find out that it is 50,000 pesos off. Remember, the lamp that we were just willing to travel to save the 50,000 pesos, would be willing to do that on the table. So many of us are shaking our heads, no, because you're doing the calculation of the percentage off, right? You did the calculations, right? But your bank account doesn't care. Your bank account said if it was willing 10 minutes of your time in the first scenario, you ought to be willing to do that off of the same base rate. We don't think in absolutes. We tend to think in relative comparisons. Unfortunately, those relative comparisons lead us to making suboptimal decisions. If we were willing to travel 10 minutes for 50,000 pesos, we ought to be willing to travel 10 minutes for 50,000 pesos. But there's this resistance because you're like, yes, but it's off. It's a different discount amount. It's a different deal. So this is a kind of bias that's called mental accounting. Behavioral economics is the scientific study of human behavior that goes beyond now just understanding. This is what's so exciting about behavioral economics. I was in the banking sector and the technology sector for about 20 years before going fully devoted to behavioral economics, because not only is it the research insights, but more importantly, It gives us a set of tools and insights that we can use to actually change behavior. The research, learning about the biases, sure, that's very interesting. But actually, behavioral economics gives us new insights to actually impact and influence behavior. And so I'm excited to share these with you. So one of the terms that's emerged from behavioral economics is this term called the nudge. And what it essentially means is that we can change the design of the way a choice is presented to people, and just by virtue of changing that choice a little bit, we can have a significant impact on people's decisions. And so this whole framework is called choice architecture. We see ourselves as choice architects. And you too are choice architects. Every day you're trying to get people to do things. And so, how are you doing that? What science and insights are you using to help people to make choices? So there is nothing that's neutral. We just might not realize how we're doing it. So I want to use a couple of fundamental examples. So one of them is this. If this is a form and that first item is already pre-selected, you're actually already more likely to do the thing that is pre-selected. That's for those of you who are in the digital channels. Just by virtue of already having something pre-selected, you're already likely to have an impact on people's behavior. And I want to show you an example of this principle from a very different domain that I think you guys might find surprising. So this insight about the status quo bias can actually be seen in terms of people's participation in organ donation. Organ donation, in the event that something tragic happens to someone that we love, is an option that they can pursue in terms of donating their organs to someone who's still alive. When you ask people how they feel about organ donation, is it something that they believe that they would participate in many countries around the world, the vast majority of people say yes, it's the right thing to do. So now let's take a look at this data. So what this data shows is when we look at countries like Denmark, the Netherlands, the UK, and Germany, we have very low participation rates. And then when we look at these countries, we see that they have high participation rates. So now, if we take maybe a traditional marketing approach and we try to explain this, how can we explain this? What is this difference? Are these people more selfish? They don't care about others, and these people are particularly generous? We can't actually use demographics to explain the difference. Germany and Austria are neighboring countries. We have the Netherlands and Belgium. They're also neighboring countries with very similar demographics and cultural values. So how can we explain the difference? Well, it turns out that the enrollment process for organ donation is similar in all of these countries. It's a part of the driver's license registration. But the only difference is this. In these countries, you have to check that yes, you do want to donate your organs. And in these countries on that same form, the wording is different. You have to check if you do not want to donate your organs. So it's a very subtle framing of what the default option is that has this huge sway on people's behavior. Now, one of the things that's very interesting is you see the Netherlands is a little bit of an outlier relative to these countries. And it turns out that they sent 12 million letters out in a population of 16 million, and they got that little boost. So for those of us who are driving education initiatives, it gives us kind of a line of sight on maybe what are some realistic impact that we could expect to get. So I want to show you now this organ donation example that's being applied in retirement savings. And I want you to see this application from, here was a bias and a nudge, and now let's see it applied in a different industry. These are retirement savings rates for employees of companies that have a retirement savings program that's a part of their benefits package. This is in the United States, where you get a tax a benefit for redirecting a portion of your income directly into your retirement savings. So, economists, it's classic free money to participate in these programs. However, as we could see from this blue line, when employees are left to their own time to enroll in the retirement savings, it takes years to reach the point where you have about half of your employees enrolled. So the idea was tried. What if, instead of letting employees register themselves, what if we default them in? By defaulting employees in, they don't have to go through the process of making the calculation of how much of their salary they should have enrolled, which investment products to choose, how to balance their portfolio. We just default them in, giving them the option to opt out at any point in time. So that freedom is still there. And now the decision is made on their behalf and in their best interest. And we see that people tend to stay at new enrollment base rates of 93%. So the thing about behavioral economics, though, is we need to think about ethics. It's very important for us to understand that just because we can have a significant impact on people's decision, it doesn't necessarily mean that we should. In fact, defaults can backfire too. So, for instance, one of the challenges is that companies tend to be very conservative with what that default savings rate is. Conservative relative to what a good financial advisor would say we should be setting aside, at least 10% of our income. But most of us, when we do this on our own, we save significantly less. And also, when employers are defaulting people in, they tend to choose very conservative amounts, like 2% and 3%. The challenge with this is now employees are defaulted in. They're enrolled in the program, which is a very good success, but they're enrolled in it at an amount that is not optimal for their financial decision making. So Australia has taken the step of mandating significantly higher default rates, which has led to a significant change in the overall savings rates of people in Australia. This example of retirement savings is a very fascinating way to see how behavioral economics is being explored and tested around the world. So BE can help us in the insurance domain as well. So we have the biases, we could drive these interventions and nudges, and we have experimentation to let us develop empirical insights about what works. We can help understand why people are making the choices that they're doing. We can help our customers make better decisions. And then ultimately, we can develop evidence-based strategies using the scientific method to test our theories. In fact, since 2009, there's been an upsurge in the number of insurance firms that are using behavioral science. So for instance, we have projects that are across the value chain. We see behavioral economics being used to drive acquisition and retention, customer experience or engagement, which is a kind of a broad term, and even customer value. And we're seeing a healthy and meaningful impact by bringing behavioral insights to life inside these organizations, providing better value for our customers and ensuring that people have insurance. Another example is Lemonade. How many of you have heard of Lemonade? That's wonderful. So the chief behavioral officer there is my co-founder and business partner and longtime friend, Dan Ariely. They also use much of the research of Nina Mazar, and I'll talk more about some of the other research that Nina has done. It was important to bring Lemonade forward because this is a beautiful example of where we're bringing advanced technological capabilities together with behavioral insights, where we're looking at things like AI to help us make better claims, but using behavioral science to actually challenge people maybe making claims or the amount of claim that they're making in the first place. So when we bring those two things together, we have an incredibly powerful new tool set. And so I'd like to show you some case studies about the work that we've done in bringing behavioral psychology to life inside insurance companies. So I have 4 case studies that I'm sharing with you guys today. So one of them is the theory of operational transparency. There was a fascinating project done by Harvard professor Mike Norton, who worked with an e-commerce site that does travel. The website's called Kayak. And one of the things that's so fascinating about behavioral science is how it challenges our assumptions and our instincts about what might be the best way to create a customer experience. When we think about digital, we think faster. The faster the engine, the better. The faster we generate those responses, the better the customer experience. This was tested. So I'm going to tell you, here's an example where you should slow down your website, make the process longer, and take more steps to lead to better customer satisfaction, higher perceived value, and better likelihood to buy. Challenging our intuition. This is one of the things that's so beautiful about psychology. So how does that work? Well, it turns out that when the computer works like this, people are not getting any sense of the amount of effort that has been undertaken to create those results for a person. The Kayak website, very simply, it does more than just show the best travel plans for you. Instead, you see all of the options coming by on the screen, and they've even been slowed down at different rates. And then finally, the results are presented. What this conveys to the user is that there's this ton of data that's being sifted through, more than I could ever do as a customer, that the company has made all of these deals, has gathered all of this data, is doing all of this mechanical, algorithmic review to find the best deal for me. It's about bringing the work effort forward. Operational transparency. And we've tested this concept in a few different domains. One of them actually is in the utility sector, where people don't understand what they're paying for. It's very abstract. So we tested this in the insurance industry, and we did the same thing. We had the website, have this meter. It shows up a little fuzzy here, but it shows the barometer going by as we're looking for the best deal for you. These are examples of making the process seem as if there's actually work being done too quick, and you don't necessarily get the value from it. We took it another step further. We tested it in our call center, but we mixed call center with digital. We developed a PDF, and the PDF also had this notion of operational transparency. What we did was we took the time to describe the whole process to the customer before we started to ask them questions. Now, it seems like that took a long time, but it didn't take that much more time than leaving people on their own, but had a very positive impact on purchase rates as well as cross-selling. So we outlined, these will be all the questions that we are going to go through with you. Here's how they work together. And then we let them understand the impact on the base quote as they made different choices. And so we measured many different things. Some of the data I'll share with you in the time that we have is an impact on both purchase intent as well as perceived value. So it's not that we're actually educating customers on here's how insurance works and here are all the elements. Instead, it's more meta. We're making this process open to you. We want you to see this is all of the work that we're doing for you. These are all the steps that we'll be taking. What that does is it increases the sense of trust and improved reliance on the expertise of the financial institution. And we found that across domains and across channels, that operational transparency leads to a positive impact on perception and their behavior in terms of things like likelihood to buy, cross-sells, and other measures. So another project we worked on was, again, about testing assumptions. Our client had the hypothesis of creating these bundled offers for clients, allowing clients to actually do full self-selection versus bundles. They had had product bundles before, but what they believed was that maybe we should allow customers to do full selection themselves, kind of build their own product. And the intuition that they had was by letting customers make a full selection and do personalization, the intuition was that that would lead to people being happier and more likely to buy. So that's an incredible question. Building that infrastructure for the customization would have been an incredibly expensive project. And so fortunately, they took the time to stop and test that assumption. And so, in fact, we ran a series of basically scenario tests that evaluated whether or not that had the impact that they thought it would. These are the different measures that we considered. Everything around, for instance, trust. What is the relationship between creating bundles for customers and letting customers make their own choices? And what we found was that when we actually give people the recommendation, they feel happier and they're more likely to trust us than when we have them. The question that emerged was things like, don't you guys actually know? Why are you making me make the decision? And it left them feeling anxious. And so we did not recommend going with the customization approach to build your own insurance. Another example that might be well known is this asking customers how many miles they drive in a typical week as a way to determine the form of the policy. One of the ways, because this is self-declared, is they can sign the policy at the end of the policy versus signing at the beginning of the policy. The language is different. When they sign at the beginning, it's an attestation that the information that they give will be correct and honest. When they sign at the end, they're signing that same thing, that the information that they did give was honest and accurate. But it turns out that there's a 10% difference in the number of miles that people claim to drive in a typical week. In this experiment with over 15,000 policies in field, leading to a difference in the cost of the premium in favor of the insurer. But by having people sign at the top, they were more likely to be honest than signing at the end. Now, from a legal perspective, in many cases, we're obligated to also have them sign at the end. So we just do both. We just have two attestations as a way to work with the legal declaration and generating this impact on people's likelihood to remember how many miles that they're driving. So my fourth example is to show you a case of behavioral economics applied in an end-to-end project affecting enrollment, improving acquisition. This is a case of health insurance where a significant number of eligible employees were not taking advantage of the opportunity to purchase insurance. And we addressed retention. A significant number of employees would cancel their policies within 3 months of enrolling. And so we do the diagnostics, what are the psychological barriers? One of the things that's been very fascinating for us is often when we're working in the room, we see the product people tend to blame the actuaries, who tend to blame marketing, who tend to blame sales for sometimes the acquisition numbers. And instead, none are considering that it's not the product, it's not the price, it's how we're positioning and what the actual sales process looks like with our clients. And so this recognition of the barriers gives us different strategies that we can develop to overcome these barriers. So some of the things that we looked at, so we built a journey map across the enrollment experience. And then we considered where our behavioral intervention points would best be served. And so we looked at things like pre-enrollment email series and a couple other examples I'll give you a close-up on. So one of them is this idea, this is a mock-up of these employees have the opportunity to meet with a benefits counselor. The employers typically just say, you have a benefits counselor, you should talk to them. Instead, what we tried was a framework where it looked as if an appointment had already been booked at a preset time with a preset agent at a preset place. And we give them the option to change where that meeting is taking place. It turns out that people are significantly more likely to go to a meeting, or they have a meeting but they've changed the date, when they're given this kind of preset invitation than when they're just given an open invitation. When a customer or potential customers sit in front of the advisor, they're significantly more likely to end up getting health insurance that fits their needs or their family's needs. So this is a way to get people sitting in front of the advisor. Another thing that we tested was one of the challenges with buying insurance is it's very abstract. So how can we get people to feel good about the decision that they make? So we use post hoc rationalization to congratulate people on the decision. So not only do you get the benefits package, but you also get congratulations in different forms about the quality of the decision that you made as a way to reinforce it. And we had a very significant impact in people's likelihood to enroll, but also cross-sell of different products as a result of this process. And so the overarching conclusions then is that BE enables us to try things that we wouldn't otherwise try. And it gives us an opportunity to help transform our industry, to help get insurance in the hands of people that need it. So behavioral economics then helps us to understand our customers so that we can help them to make better decisions. Thank you very much.
Thank you, Kelly. Beginning now, those of you who have questions for Kelly about her presentation, we will answer them in the stand-up from the Fasecoldas stand. We'll pass around a microphone.
Hello, Kelly. My name is Eric Ramirez. I work at Swiss Re. I'm from Mexico. So we know that within the insurance industry, we have an issue with the trust. So some people think that the pre-selected options are unethical or not a good practice. So how do you think this could be impacting to the insurance industry if we decide to implement that?
Definitely, the issue of trust is very broad, and it's not unique to any one country, and it's not unique to any one product. We definitely live in an era of skepticism and concern, and the complications that we've had from other financial events have not left the mind of the consumer. So they think that we are out to gouge them. And so we need to deal with this issue of trust, because in absence of things like insurance, we have people that are left without any form of coverage. So we need to think about different ways that we can solve this problem. So the benefit of operational transparency is it's one of the solutions that we can take. And I know it's a bit tricky, because it's like on the one hand I'm saying bundle it, make the buy easier, and on the other hand I'm saying make the process transparent. On the one hand people say make it simple, make it easy to buy. On the other hand I'm saying slow it down, add extra steps. So how do we bring those things together? The fundamental theory of, for instance, this idea of operational transparency is that we want people to see several things. One is we want them to see how we're making our decisions, that there's nothing nefarious there, that the elements that we use to price our policies, to choose the best fit, that they make sense. They don't need to go through all of those decisions with us. Some will, but it's a small number. They just need to know that we're willing to be open, we're willing to be transparent. Just that process alone already starts to open up and relieve some of the anxiety, so to show how that process happens. Those are the kinds of things that we can do. One of the things that Lemonade is doing is aligning the conflict of interest. So if it's in, like customers already assume we don't want to pay out claims. So why don't we make a shared relationship, a shared goal between what happens with unused claims. Here's our prediction of the claim. Here's what's happened. We don't keep that for our profits. It's just going to be donated. So where we tackle these barriers head on in ways that might seem counterintuitive, those are two examples of strategies that we can try to increase the level of trust that our clients have in us, not only to buy, but to stay policyholders and to increase the product complexity, maybe as their own needs increase in complexity. I hope that helps.
Okay, thank you.
We have room for one more question. No more questions? Yes, over here, one.
Hello, my name is Carlos Javier Roman. I'm the CMO of Equivida. It's a life insurance company in Ecuador. My question is regarding the traditional marketing research.
Yes.
What do you think about it and comparing with economics, behavioral economics?
Thank you for a wonderful question. Traditional approaches would include things like surveys and focus groups. And we need to recognize that those can be very useful for us, but they're very vulnerable to all kinds of biases. And we're starting to understand the biases that exist either in survey design or in focus groups. What I'd like to say in brief, they're great to use to help us generate ideas, to help us generate hypotheses. They're fantastic in the discovery phase, but we shouldn't base our dollars on what we're learning from those kinds of methods. Instead, the best thing is to actually introduce a method of the randomized control test, where we can actually look for a causal relationship between our hypothesis about what might work, the different ways we can manifest that or design those different theories, and then test those in the real world. So it's time for us to move past looking at tools like surveys and focus groups. We've learned so much. We've learned about customers' anxieties. We've learned that they find us frustrating and complicated and distrustful and hard to work with. We know that already. And maybe we'll learn slightly subtle differences, but now I think the most important thing is for us to actually start to move into first augmenting that knowledge with the biases. Because our customers won't tell us, oh, well, one of the reasons why I don't buy insurance is because I'm present biased, or because I have this view of probabilities that's misguided based on most recent events. Customers can't declare these biases, and yet these biases are far bigger barriers than the perception of simplicity of the service experience. So incorporate biases into our research base, and then more importantly, start to use the randomized control test to test those fundamental assumptions and experiences and observations that you've had about humans and how they're buying products and services. Start to use the randomized control test as the new most powerful tool that we have. Thank you.
Let's give Kelly a big round of applause for her wonderful conference.